My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Interest rates soaring? Check. Inflation raging? Check. Paid $120 at the pump? Check. President confusing the already muddled inflationary waters with apocryphal messages about Medicare pressuring drug companies while he hounds the only possible allies he has to bring down prices, the oil companies? Check. Europe agrees to cause more self-inflicted pain by banning Russian oil sales? Check. China says it's open for business, but it looks like only paid actors are tugging the streets right now. I mean, wasn't that? They were actors. Check. It's all bad. But if it's so bad, how could we come back from a huge down opening with an ocean of red ink to have a not-so-terrible close? Dow dropping 223 points, but it flirted with much higher. S&P declining 0.63%, NASDAQ edging down 0.41%, despite the bonds just getting crushed. There's a simple reason. I think inflation is starting to peak, and the Fed's there to push it over. That's why this market became more resilient, even on a bad day, a day that could have been down big after last week, which was the best performance the market has put on in 2 years. Where's the giant profit taking at least? We're in a remarkable moment here where we have switched from wanting growth to wanting no growth, as long as we don't have negative growth, a.k.a. shrinkage. No growth may be a worthy goal for the Federal Reserve, even as the president would prefer an economy with more stable growth. Hey, wouldn't we all? Based on his statements today, Biden doesn't just want to avoid a hard landing. He doesn't want us to know the plane's experiencing turbulence. Can that happen? You know, the stock market is saying yes. The astronomical checklist of worries seems almost to inspire buyers, even as dividend stocks finally have some worthy competition from the bond market, given that the 10-year is sporting a 2.84% yield and your money back guaranteed. Unlike stocks, remember, treasuries are basically risk-free. Sure, the government can stop paying its bills, but at that point, you got a lot bigger problems to worry about in your portfolio. So how the heck can stocks compete with bonds? Well, it doesn't hurt that they've now fallen so far that they represent much better values than they did last November. Let's just pick three of them. Let's start with Amazon. Now, here's a stock that's down nearly 28% for the year. Amazon. Many investors no longer consider Amazon a growth stock, even as the stock sells for 45 times next year's earnings. I know, it's outrageous, ridiculous, even if there's no growth. You know me. As I will repeat for CNBC's Investing Club members at my noon conference call on Thursday, I want to own the stocks of companies that make real things or do real stuff and turn a profit in the process, profits that can return to shareholders in the form of dividends or buybacks. As long as your shares trade at a reasonable valuation, everybody's entitled to make mistakes, and Amazon's made some big ones. It's gone from an evergreen fast mover to a COVID play that's mentioned in the same breath as Peloton or Zoom video. Frankly, I think that's insane. It makes me angry. Amazon is a company that earned $82 a share in 2024. Now, before you laugh about me using 2024 estimates, remember that 2022 is almost half over. These fastest-growing companies, and I insist that Amazon is faster-growing than most, simply are not going to sell at the market's average multiple of 18 times. That's what the S&P, you're paying for their earnings. It's not going to happen. And it shouldn't. I think Amazon can sell at 27 times earnings if it takes its medicine. Now, what would it mean for Amazon to take its medicine? Well, they got to cut back on warehouses that are no longer needed, cut back on workers who can get new jobs quickly if they let them go in this environment, and get more aggressive on the advertising side of retail while maintaining a big lead in the cloud with Amazon Web Services. Next thing you know, that $82 of earnings per share in 2024 turns into $100. And you're buying Amazon stock for close to a market multiple in those numbers. While it's not as insulated from the Fed's rate hikes as I'd like it to be, understand, unlike traditional retailers, Amazon's not going to be stuck with huge inventory. No glut here. No giant amount of overhead once the medicine's taken. All right, I got another one. How about a company that now sells at a gigantic price-to-earnings multiple discount to Coca-Cola or Colgate or General Mills or Campbell Soup, despite having a better balance sheet and a much bigger buyback? I'm talking about Meta Platforms. Yeah, the artist formerly known as Facebook, with a stock that now sells it for 14 times next year's earnings after this decline. By comparison, look, let's just compare Clorox, right? I mean, it's kind of like, Clorox is chlorine. It sells for 27 times next year's earnings. Meta Platforms, which will begin to trade as META, not FB, starting June 9th, as we learned later this evening, saw its stock get obliterated last week when Snap, the parent of Snapchat, missed its quarter. Snap? Oh, the indignity! It's like Meta's back to being just Facebook again. No Instagram, no WhatsApp, no Reels. They're TikTok killer. And, oh, by the way, I think it will kill TikTok. The stock's trading like the whole Metaverse thing is just one big joke being played on Mark Zuckerberg, which seems pretty unlikely to me, given his track record. At this point, you're thinking Zucky at the plate, at the bat. And mighty Zucky has struck out. Hey, forget striking out. He ain't even in the stadium. Oh, and before you poo-poo the Metaverse, let me give you a little heads up. Jensen Huang, the genius behind NVIDIA, is his partner in the project. Even if you don't trust Zuckerberg's judgment, some of the smartest guys in the industry have bet big on this thing. I know you're thinking I'm about to spell out FANG again. No! I'm not going there. Some of them are too expensive, and I think the acronym's no longer useful. But let's take another underrated name from the old FANG. Let's call it Google, now Alphabet. Let me tell you something about what Google really is. Before we handed off my Mexican restaurant to our partner Petro, forced to do so, by the way, because under federal rules, you cannot own both a liquor company, as my wife does, and own a bar, as I do, a resident of something called the Tide House Rules, where companies that make liquor aren't allowed to sell it in an establishment. Like how car companies aren't allowed to sell vehicles directly, they have to bring in dealerships as middlemen. But when we still had the Mexican place, we had to figure out what kind of advertisements give us the best rate of return. I was thinking maybe it would be flyers. Or next door, now reduced to a stock under $3. Hey, free beer. Never a loser. But hands down, it's Google. Because people Google everything. And you can get people to come to your place by being at the top of the queue. At the same time, you can send people directly to your own liquor brand using Google. Well, at least it sends it to the brand. It doesn't mean that it's a place to buy. It's not like Amazon. Google remains the best way to advertise, and we all know it. If you're cutting back on advertising, you're not cutting back on Google. You're cutting back on everything else. Google is the way you move product that you can't move on Amazon or Instagram, the other two places you can sell things. So you think they get hurt when Snap gets hurt? I don't even think they're in the same business. So what's really happened here in the miserable months since the Fed decided it had to stamp out inflation? Simple. Amazon, Facebook, and Google have become colossal losers. And while they may stay losers, the bottom line is they've fallen so darn far that I think they've become metaphors for a whole host of stocks that are now ready to rally because they've got nowhere else to go but up. James in Virginia. James.
Booyah!
Booyah! I like doing? That. Booyah!
So since 2020, I've been loading up on Lockheed Martin. I'm questioning, should I hold here or double down?
I like Lockheed Martin so much. When I was going over the charts this weekend, I saw Lockheed Martin and I could throw in Raytheon Technologies. Both of them look terrific. I want to be a buyer of Lockheed Martin. Rachel in Florida. Rachel.
Hi, Jim. Thank you for taking my call. Second-time caller now and member of the Investing Club.
Oh, fantastic. See you Thursday for our conference call.
Yep, I'll be on it.
Oh, great.
I wanted to ask about this real estate stock. There's a lot of opinions right now in the real estate world, and if we're going to more slowly increase housing costs, or if we're in a bubble it's about to burst, a lot of opinions on mortgage rates. From what I hear, there is a consensus of perhaps a 7 to 8% mortgage rate by end of the year. I have been selling a few of my stocks at a loss to try to purchase other stocks, and as you put it, high grade my portfolio.
Yep.
With that being said, for someone with, let's say, a 10-plus year investing horizon, this stock's pretty much at its lows. I'm down around 63%. Would you say Zillow is a hold or sell right now, or maybe even a buy?
I can't say buy it. I think that the company has in many ways made so many ill-advised decisions of late, and they're not making money when you look at the past. In the future, they might. It is still an expensive stock. So the answer is I can't go there. All right, guys, listen. I'm trying to describe a world where some of our favorite stocks have been crushed. Amazon, Facebook, and Google, now Facebook, by the way, is Meta, became big losers. And while they may stay losers, I think they've fallen so far that they've become metaphors for a whole host of stocks that can rally because they've got nowhere else to go but up. Oh, man, buddy, tonight, Salesforce poured at the bell. So what could the Cloud King tell us about the state of tech amid the recent crunch? Let's talk to the CEO. Then Larry Williams has an impressive track record with his technical analysis. I'm going off the chart to see if this market could have more room to run. And fresh off earnings, I'm getting the latest from the CEO of HP, to see if the PC and printing company could continue to navigate everything from inflation to supply chain concerns. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.